It's Wednesday, September 27, 2023, episode 13 of the Market Huddle Plus. I'm Patrick Ceresna. This week, I have the pleasure of welcoming to the show Interactive Brokers Chief Strategist, Steve Sosnick. We discuss the market's correlation and dispersions, impact on volatility, and the impact of buy, right, and short vol strategies on the options market. Quick disclaimer. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much market huddle may include sell too early swirlies, fat tail morning bail, and quad witching stitches. Let's get Steve on the show. Steve, always a pleasure to have you back on the show. You've always been a good friend and a fan favorite. How are you doing today?
I'm doing great, Patrick. Thank you. It's always a pleasure to join the show. It's one of my favorite. It's one of my favorites. So I'm happy
Thank you.
to have a part in it.
So listen, I wanted to talk volatility, but you know what? I had to pick your brain here on these markets. We have the S&P 500 at multi-month lows, including we dropped 250 points in less than 2 weeks. The dollar index breaking to a new high for the year. Oil breaking to a new high of the year. How do you size up these markets?
Well, the simple answer is it's seasonality, but that's kind of a cop out at some level. It's easy to say, well, we went down in August, we went down in September. It's seasonality, but I think it was also sort of, a little bit of a Wile E. Coyote moment. Now, just to put things in perspective, we have not closed above the levels that we closed at on July 31st. So pretty much, August had its backing and filling, September had a little bit of backing and filling, but we're down 5% plus depending on your index of choice over that time. And that's obviously a pretty substantial move. But I think it was very hard for the markets to completely deny the idea that we had narrowing leadership, that we had yields going up dramatically, that we had a stronger dollar, that we had stronger oil prices. If I lay that all out to you, your answer would be, of course we went down. So I think it sort of was a delayed realization. It's actually more interesting to me that it took us this long to figure this out.
Right. And, but do you think the rising dollar and oil prices are having that impact, or you think this is somewhat just that the index from a seasonality perspective is was overdue for one of these corrections?
I think they're all contributing factors. I haven't really tried to sort of suss out, which of them deserve which weight. Um, whether one is a bigger one than the other. I think if I had to lay it out, I think um, some combination of the seasonal realization that we had a narrow group of winners. Then on top of it, the realization that rates keep going up, which then drags the dollar up, which of course is not good for multinationals. But it's very interesting. I mean, it was really like Powell threw this dose of cold water onto the market, saying, we're not cutting rates anytime soon. And I think that the market is just so programmed, so addicted to be looking for monetary accommodation, no matter how you get it, and to find out that it's not coming is just sort of a cold hard fact that I guess it had to wrestle with, and I think that explains sort of this latest leg that we're seeing.
Right. Right. So listen, I want to talk to you about the article you sent me about correlation and dispersion of returns and its impact on volatility. But I really wanted to first hone in on the Mag 7, and it's in line with your dispersion piece, but there's this enormous weighting of these Magnificent Seven stocks in the index. How do you think it might be affecting the index vol?
Well, I mean, first of all, you never really want to see such concentration. I mean, I'll throw terms like Nifty 50 and one decision stocks and other similar type of situations that ended badly where you had narrow leadership. But speaking in terms of volatility specifically, they've tended to move sort of as a group, but they've tended to move as a group not in sync with the broader index. It's not a secret, and I've written about it, and I'm one of many, who've noted the divergence between, the indexes as a whole, which are heavily weighted toward these big mega cap tech stocks, and the equal weighted versions. So meaning that the average stock has treaded water or worse, while these stocks have gone up. But from an index construction point of view, let's take a very simple index, and you have a handful of stocks, and if half those stocks, let's just assume they're all equally weighted, but if half those stocks go up and half those stocks go down by similar magnitudes, well, then you've gone nowhere from an index point of view. And I think because these stocks are so heavily weighted, call it roughly 25% of SPX and 50% of NDX. So they're going up and the rest are going down or treading water, and that actually has um, a dampening effect on volatility. And that's the mathematics of it. Then the second part was, I think the market then misread that into complacency, and I think it became difficult to separate the math from the emotion or lack thereof.
Yeah, like it's noteworthy that the equal weight S&P 500 is almost back to its May lows. Just a serial underperformance on a relative basis. It really kind of shows the impact of those huge stocks and how much they are really contributing in that bigger context, right?
Yeah, I mean, if you invested in, a portfolio is called the Magnificent Seven, even with these recent pullbacks, you're still at multiple double digits year to date. Now, to be fair, many of these stocks also got clobbered late last year, and so they got off to this great start, which I think was partially the January effect on steroids. Um, but then throw in some AI mania on top of it, and this belief that they're sort of bulletproof, and you had money just flowing in, and that became, it took on a life of its own, to a point where it really overwhelmed the rest of the market.
Right. So, I mean, you obviously wrote this piece about the dispersion in that equity returns, but how does that actually contribute to the lower volatility levels? Can you elaborate so our listeners can understand that better?
Sure. It goes back to what I gave the sort of the brief version, but I'll get into it a little more. Um, an index an index of stocks, um, move when an index moves, you have the stock. It really is, the question is, are the stocks moving in unison or not? So when your markets go down dramatically, as we've seen over the last few days, you look at the advanced decline line and you see, decliners way outpacing advancers. So that's telling you that, it's a get me out trade, that correlations are quite high within the index. But at any given point, in rising markets, you have the concept of rotation. So some stocks go up, some stocks go down, some stocks go sideways, and if they're all moving in different directions, it dampens the volatility. So so even to a certain extent, historical volatility, when you look at an index, it's gonna move one way or the other. And that's a mathematical construct. It's literally how many, what's your absolute value move each day, whether you're looking back 10 days, 30 days, etc. Um, but if but if you have all these index components largely moving in opposition to each other, and in this case you had, calling the Magnificent Seven, moving largely in opposition to the other 493 or the other 93, depending on which index you're looking at, um, that has a dampening effect on volatility. So the index moves. For example, if it was just an index of the Magnificent Seven stocks, you would have these indices would be much, much higher. So something is dragging it down, and that's the other stocks that are in the index. Or conversely, you'd have some really lackluster performance if you accepted if you got rid of those stocks. So when you're creating an index, if some, it's the covariance of these things. It's how they move relative to each other. So when you have everything moving in sync, vol tends to go up. When you have things moving in different directions from each other, it does have a depressing effect on volatility. And I hope I got it that time.
Okay.
let's throw a link into the
Well,
piece where I explain it
yeah,
if you can, because I
absolutely.
think I
So,
could do it better. I think I do it better in writing
no,
than I'm doing it verbally.
oh no, fair enough. We'll throw that link on there and we'll include it in some tweets, so we'll make sure everyone can get it because it is a really interesting and well articulated piece. What I wanted to though just ask you in that sense, like obviously, one of the famous sayings is like during a liquidity event, the correlation of all these assets go to one. When you see this kind of a dispersion, do you think that this is a true left, like a tail risk anyway, that we suddenly have something that kind of shocks the system and that dispersion disappears and it kind of just sends this vol shock through the system? Like, how would you envision something like that playing out, or do you even think it's an immediate risk?
Well, I think we've actually seen the market sort of come back to its senses. One of the things I put out recently, I think in the piece we linked, but I wrote about it in in a piece I wrote today. At the time, it was kind of perplexing to me because the correlation measure that I was using was it's the SIBO 1 month correlation index, COR1M is what they call it. And when you plot it, when you overlay it with VIX, they move pretty much in lockstep. But then over the last few weeks, the correlations the correlation started to move up, but VIX didn't, and it just sort of laid there. And that to me was a tell. Um, and I will admit, I got long a bunch of VIX call spreads, bull
Yeah.
call spreads, which after today's move I'm out of. So we'll see if this was good timing or just taking a profit. Um, but the index largely the VIX like over the last day or two largely snapped back into place, and now at least when I looked at it earlier today, it was keeping up with the correlation index. That's where I was saying that I think we got into this um, complacency move where we were sort of ignoring the rest of the world, at least the major volatility indices were. And one of my classic sayings is, the VIX is not a fear gauge, but it plays one on TV. Um, I don't like to think of that as strictly as a measure of fear, but I do look at it as a measure of people's desire for volatility protection. And
Yeah,
it and it's like
you use that example of the price of parachutes, right? Like that, I love that. If you want to share it,
exactly, the way I've often said it is, as an options market maker, which I was for over 20 years, you're basically selling parachutes. And when the plane doesn't hit any turbulence, there's no demand for parachutes. When the plane hits turbulence, believe me, the price of parachutes goes up dramatically. And that's how I view VIX to a large extent. And that's where I got very confused over the last few weeks was, uh, you know, it was obvious that there was some turbulence starting, yet there was no demand for the parachutes. And over the past couple of weeks, we went from call it 13 and a half on VIX to 19 in very short order. All of a sudden, people started to pay attention to the fact. The other example I use is, the guys in a big city who sort of materialize to sell umbrellas. You don't see them because there's no demand for umbrellas when the sun's shining. And as soon as the clouds form, as soon as the first few drops of rain, out come the umbrellas and out comes the demand for the umbrellas. So it's all related. And that's, with all the talk of zero dated options, replacing VIX, et cetera, bottom line is it is still the best way for institutions, and I do believe individuals as well, um, to quickly hedge their portfolios, to quickly get some insurance, whether it's a parachute, an umbrella, et cetera. Um, and that's when you see VIX start to shoot up, and that's when you start to watch the VIX futures curve for any potential inversions, because that's usually when it gets a little out of hand. That's when it tells you there's a real scarcity of available volatility protection. We're not there yet. We've really, in my mind, just gone from complacent to relatively normal,
I was about to
which
say that.
still argues a little lower. than it
Yeah,
should be.
that the part that I find fascinating is like, okay, when we had that sell off in the market in February March, the VIX went roaring up to 30. Here we have the equal S&P point drop from peak to trough in terms of total points lost. And even the velocity and the selling was of similar magnitude. And yet we're not even on the 20 handle on the VIX. It just seems like that turbulence hasn't been bumpy enough for the parachute demand to come up.
Well, it is a little bit different because what you had in February, March was existential fear. Um, you had people who thought their money was safe in a given bank, and then had to question whether the bank was oops, then had to question whether the bank was going to um, be there to pay them off. And that's a big difference. Whereas now this is more considered sort of the garden variety sell off, at least so far. And so that's why you're not really seeing that visceral panic. You're just sort of seeing, maybe I shouldn't be pressing my bets shorting vol here. Maybe I should just sort of treat it as a bit more normal. But that's why you haven't seen that demand. Um, you know, it, just after I said it's not, VIX is not a fear gauge. It was reflecting an awful lot of fear. And if you thought you had money in the bank and then had to question whether that some of your
Yeah,
safest assets would pay off, of course you're going to start to apply
buy
sort of a
insurance.
different risk mentality to your riskier assets.
Right. Okay. So, well, listen. I want to kind of share a thought I had, and I want you to tell me whether I'm on the right line or whether you have a different view on this. So, like you stated in the article that the VIX declined because a lot of people got more comfortable with the level of risks in their portfolio. But I speculate that there's something more to it. And one of the things that I kind of am speculating that the high interest rates had made call premiums very attractive on an absolute basis. And this is at a time when it is consensus that with a very tight Fed, the market upside is limited. And therefore, in principle, the idea of a buy write or a covered call writing strategy is a very natural, return enhancing strategy to try to create alpha when you think there's limited upside and there's all these rich premiums there. So my question for you is, do you see evidence that in the open interest that this is fully in play in any way, do you think it's a key contributor to the kind of short gamma low vol conditions?
So there's definitely been a huge, a significant increase in writing options, whether it's writing calls because of income, because as you note, um, buy writing is a strategy that tends to work when stocks are going sideways to modestly down, which they are in the vast majority of situations. Um, but it does have an effect on the market. I do think people have gotten much more complacent about selling volatility in general. We're even starting to see, we're starting to see sort of the tide turn on one, zero dated options, one dated options, where people are getting a bit more people have finally figured out that that's sort of the meatiest part of the decay curve to be selling. There's few guarantees in option land, but one of them is you'll have no extrinsic value at the end of the day. No, nothing beyond, and so any premium you pay will vanish. Um, People have gotten hip to that. But what it does mean that you can actually influence the market. And I think of the example in a market you and I both know well, Patrick, and that's Canada, where you have this large popularity of buy right funds, and you really do start to see a very depressed upside. Let's call it a very steep Elvis smile or whatever we want, however you want to put it, and it does have an effect on the market. And I think that's um, I think to a certain extent people's comfort level with selling volatility, which is really an unnatural trade for a lot of people. They got comfortable with it, and I think that's kind of why you had this delayed reaction to both to both the increased correlation in the market and just the downward move in the market, and why you've seen VIX kind of leap in a hurry. Because I think people got a little complacent, but remember, all these measures do measure upside and downside. It's not like it was, 2021 where you had, um, the huge skew to the upside because people were just piling on calls. I think you've kind of flipped the mentality, and people realize that there's money to be made from decay. But that's like the difference between a ground game and the passing game in football. You make money slowly, with some risk, as opposed to your big returns. And that's not necessarily how people that's how professional traders are wired, but it's not necessarily clear that that's how the public is wired.
Right. Well, Kevin Muir just wrote a piece on his macro tourist newsletter there about these buy right ETFs, particularly highlighting the one he was focusing on was that Nasdaq 100 covered call ETF, the Q yield, and just how it's grown to like an $8 billion fund. And it's the question, as a market maker, when you see this kind of volumes coming in on the sell side, but more importantly, systematically, which is, they're rolling on that set day. They're always doing 1 month out. It's an incredibly predictable pattern where these funds are writing and how they're writing. What's the perspective from you? Like if you're on the other side of that, I mean, that certainly has impacted by the skew and how going 10% out of the money is some of the lowest vol premiums out there. How do you deal with that, and what do you think is going to be the impact inevitably of these funds growing into popularity this much?
Well, you start to price it in. If you know that there's natural supply, you you assume, you sort of tailor your skews or your implied volatility assumptions to match that. Um, I'm For example, if I know that there's a natural seller of 10% out of the money calls, I'm really not too concerned if I sell a few here and there because I know that they'll be hitting the market at some point. And the markets start to reflect that. Again, I go back to the Canadian example where the skews just reflect the idea that there's this perpetual supply of calls coming into the market. Um, with the Q yield, it's a little bit different, maybe because um, you know the the it, the that's I guess where the money is to be made on the upside because you still do have people, or at least till recently, had people willing to speculate on the idea that these, that the best way to play some of these stocks was through calls. That might have been a bit more prevalent $80 ago in Nvidia, but now it starts to take its toll because if you knock those um, the speculative buyers out of the market, that means that those funds are selling into a even lower volatility because you don't have the source of demand and you still have the source of supply.
Well, it's certainly that steepness of the skew allows all sorts of innovative option combinations to come in to take advantage of it to create all sorts of interesting plays, right?
Absolutely. I mean, and that's why people should be listening to podcasts like this one and
Great plug there.
reading
Like,
stuff that you and Kevin write and whatever
yeah,
because you guys talk about this. Um,
yeah.
you know, there. I'm still always a fan of verticals. I think are sort of the easiest way to do it. The best way to exploit some of these skew trends. Um, but eh, but even there, you can't lose sight of direction. I think it's very difficult for individuals to sort of be pure volatility traders. So I think the type of trades where you basically pick a direction and then use strategies to exploit the volatility that may or may not arise. Um, Again, as I said, I was using verticals that I got called out of in VIX because the at money vols were relatively high. The out of the money vols were even higher. Which was a good trade for me, and it was still willing to say, okay, if I buy a 14 and a half, 18 call spread for under $1, my risk reward, it was good. and lost for. There were a couple of weeks there where I lost because the couldn't figure out why VIX wasn't moving, and then last couple of weeks it's worked out pretty well. So that's the simplest way to exploit steep skews. But there's a multitude of ways, and I think if we're trying to keep this to a manageable podcast, I'll leave it with one.
There you go. Well, listen, Steve, thank you so much for joining us. And before I let you go, though, where can our listeners follow you and find your articles?
Yeah, I would certainly appreciate that. It's relatively simple now. It's ibkrcampus.com. We've sort of simplified the process. You could search for me, Steve Sosnick. You can find me on Twitter at Steve Sosnick. You can follow me on LinkedIn at Steve Sosnick. But the IBKR campus is really probably the best place because the stuff goes up. I try to publish something daily. I mean, between some business travel and some and some other stuff. I hadn't been putting as much stuff up, but there's stuff most days up there, and that's really the best way to stay on top of what I'm working on.
Well, thank you so much for joining us, Steve, and I look forward to having you back on the show.
My pleasure. Take care, Patrick.
All right, thanks. Thanks for tuning into the Market Huddle Plus. We appreciate you spending the time with us. And listen, you can never have too many friends. Bull market or bear market, we're just happy to spend some time together on this crazy ride. Cheers, everyone.